Right now, while every financial headline is pointing at the same handful of stocks that have already run 200, 300%, there are two names sitting quietly in the market that most investors are completely overlooking. Not because they are obscure, not because they are risky long shots, but because when the crowd is busy chasing what already moved, they stop looking at what has not moved yet. And that is exactly where the money is made. I bought both of these stocks recently. I'm going to tell you exactly what I paid, why I bought them, and why I believe the next 3 to 5 years could look dramatically different for both of these companies than the last few months suggest. If you have been wondering where real opportunity is hiding in this market right now, stay with me. This is it. Before we get into the names, a quick note. Nothing in this video is financial advice. I am not your financial advisor. What I am is an investor sharing my own research, my own positions, and my own reasoning. Do your own due diligence, understand your own risk tolerance, and make the decisions that are right for your specific situation. With that said, let us get into it. Here's the thing about this market that the financial media is never going to tell you clearly. On the surface, everything looks like it is at record highs. The S&P 500 has been making moves. Semiconductor stocks have been on an absolute tear, and the headlines are cheering loudly. But underneath that surface, there is a completely different story playing out. A massive number of respected, fundamentally solid companies are sitting at or near 52-week lows. Companies with real earnings, real revenue growth, and real long-term staying power being ignored because they are not the thing that already went parabolic. And here's what that tells me. Markets are not efficient in real time. They are efficient over time. When fear and caution cause investors to walk away from perfectly solid businesses, the investors who are paying attention get to step in and buy serious value. That is always how the greatest trades of the last decade started. Not with a hot take, not with a trending ticker, with patience and homework when everyone else was looking the other way. Keep that in mind as we go through today's two names. The market setup, why this moment is different. Here's what I want you to understand about the environment we are operating in right now, because context matters enormously when you are making real investment decisions. When you talk to the most thoughtful voices on Wall Street right now, people who have been doing this for 20 and 30 years, the tone is not euphoria. It is not panic either. It is measured patience. A deliberate kind of caution that I actually find healthy and encouraging, because when professionals are talking about prudence instead of screaming that everything is going to the moon, that tells me we are not at some irrational peak. That tells me there is still room, still opportunity, still real upside ahead for the investors willing to do the work. What is happening with corporate earnings right now is genuinely extraordinary. We are not coming out of a recession. This economy has been growing steadily, and yet earnings growth across sectors is producing the kind of numbers that typically only show up after years of pain and recovery. Double-digit earnings growth, guidance being raised for the back half of the year, analysts scrambling to revise price targets upward. That is not the setup of a market about to roll over. That is the setup of a market with more room to run. But here's where it gets really interesting. And this is the piece that most investors are completely missing right now. There is also a demographic wave building in this economy that does not get nearly enough credit. Baby boomers are retiring in enormous numbers, and they are not going to stop spending. They are sitting on record levels of accumulated net worth, and now they finally have the time to actually deploy it. Think about what that means. When you are working 50 hours a week, you do not have time to go out to dinner 4 nights a week, take international trips, golf 3 times a week, or help your kids with down payments. But when you retire, all of that opens up, and that spending flows directly into the real economy. Restaurants, travel, healthcare, consumer brands. I think this is one of the most underestimated tailwinds in this market, and it feeds directly into the kind of companies I want to talk about today. Now let us get into the two stocks. And I want to be clear about something before I name them. These are not story stocks. These are not get-rich-quick tickers. These are companies with real earnings, real revenue growth, and triple-digit year-over-year expansion that puts them in a completely different category from your average 8% grower. Hypergrowth is a different animal. And both of these companies are living inside it right now. The first stock is SoFi Technologies. I know some people hear that name and immediately write it off. They picture a flashy fintech startup burning through cash and hoping something eventually sticks. But that is not what SoFi is today. And that gap between perception and reality is precisely why I think this is one of the most interesting setups in the entire market right now. I added 650 shares at around $15.70. Could it pull back to $14? Absolutely. Could it push to $16 before I blink? Also, yes. I am not going to pretend I know where the next dollar goes. But here's what I do know. This company's fundamentals have turned a very real corner, and the numbers are not subtle about it. Look at the most recent earnings. Total net revenues up 43% year over year. Net income up 135%. Diluted earnings per share up 100%. Net interest income, one of the most important metrics you can track for any banking style business, up 39%. Those are not minor improvements in a struggling company. That is a business that is scaling its lending operation, growing its financial services products, expanding its technology platform, and doing all of it while actually generating a profit. For a fintech company, that last part is not always a given. Profitability in this space still separates the real businesses from the story stocks, and SoFi is firmly in the real business column now. But here is why most people are not buying it, and why that is actually the opportunity. When investors are nervous, they avoid anything that requires patience. They want either safety or momentum. SoFi right now is neither. It is in that in-between zone where the fundamentals are building quarter by quarter, the story is getting demonstrably better, and the stock is simply waiting for sentiment to catch up to what the numbers are already saying. That is exactly where you want to be buying. Not after everyone has figured it out, not after the run, while the crowd is still looking the other way. I believe SoFi is on a path to becoming a $50 to $100 stock over the long term. If I can keep accumulating shares in the teens, I will look back at this period as one of the better buying windows I had in this name. The second stock is Celsius Holdings, and this one is a fundamentally different kind of business. But the growth story is equally compelling, and in some ways even harder to argue with. I picked up over 500 shares at around $29.70. Celsius operates in the energy drink space, but if you hear that and immediately think this is just another beverage company, you are underselling what has actually been built here by a significant margin. The most recent earnings from Celsius were, frankly, striking. Revenue up 138% year over year. Income from operations up 167%. Net income up 148%. Diluted earnings per share up 120%. Part of that growth is acquisition related, and I want to be upfront about that because context always matters. But even accounting for acquisition tailwinds, you are looking at a company scaling at a pace that most businesses simply never reach. Triple-digit growth across every major financial metric is not normal. That is hypergrowth by definition. What I find genuinely attractive about Celsius, beyond the numbers, is the business model itself. Energy drinks are not a fad. The category has been growing for years and is showing no signs of slowing down. But what Celsius has done inside that category is carve out a positioning that resonates powerfully with health-conscious consumers, a segment of the market that is growing, not shrinking, and that commands premium pricing and fierce loyalty. They have real distribution through major retailers. They have genuine brand momentum, and they are executing at a very high level right now. Now here is the bigger picture point that ties both of these names together, and this is the most important thing I want you to take away from today's video. The biggest money in the market is almost never made by buying into what is already running hot. It is made by identifying strong fundamentals early, buying when sentiment is cautious, and holding while the market catches up to what the numbers are already saying. That is how this game has always worked. The investors who were in the right semiconductor names 2 and 3 years ago, when nobody was talking about AI infrastructure, are sitting on 300% returns today. The people chasing those same names now, after the massive run, might still make money, but the risk reward is a completely different equation. A stock up 300% in a year can pull back 30 to 40% without the underlying story changing one bit. If you bought early, that pullback still leaves you massively in the green. If you just bought last week, that same pullback feels like a catastrophe. Entry point is everything. At under $30, Celsius is a stock the market is being overly cautious about. Consumer-facing brands tend to get discounted when nervousness is elevated, but the earnings do not lie. This company is performing at an extraordinary level, and at this price, I am happy to keep adding. Let me bring this all together because I think the conclusion here is actually more important than the individual stock picks themselves. What you have with SoFi Technologies is a financial technology company that has crossed the line into real, profitable, growing business, trading at a price that still reflects the old perception, not the new reality. The fundamentals are ahead of the sentiment, and that gap is the opportunity. What you have with Celsius Holdings is a consumer brand executing at a pace most companies never come close to, in a category with genuine staying power, at a price the market has been irrationally cautious about. Both of these names share the same setup: real earnings growth, solid business models, and a stock price that has not caught up yet to what the underlying company is actually doing. That combination, strong fundamentals, depressed sentiment, clear long-term runway, is as close to a textbook opportunity as this market offers. I'm not saying these are risk-free. Nothing in investing ever is. What I am saying is that when you find businesses performing at this level, trading at these prices, because the crowd is too busy watching what already ran, you have to at least have the conversation, and then you have to decide whether you want to be the person who acted or the person who watched. If you found this breakdown useful, hit that subscribe button right now and turn on notifications. We are going to keep covering exactly this kind of opportunity, the stocks that are building real momentum before the crowd arrives. And speaking of what is building right now, in the next video we are going to look at something that might surprise you about where the smart money is quietly rotating. Not the names the headlines are pushing, the ones underneath. You do not want to miss it. Subscribe, and I will see you there.